Homeowners and would-be homeowners. What happens when you break your mortgage if you decide to sell before the term's up? I'm going to tell you all about that starting right now. So you've got a mortgage, you decide to sell your place, you're going to break the mortgage before the term's over. What happens? Well, this all depends on what kind of mortgage you've got. This is something that you discuss with your lender when you first got the mortgage, but they loosely fall into two types: an open mortgage or a closed mortgage. An open mortgage, usually they charge you a little bit more interest for it, but it allows you to do things like break your mortgage early, pay off the balance if you suddenly came into $1 million, do a bunch of things that you can't normally do with a closed mortgage. So an open mortgage is more expensive because it offers you more perks. And one of them is, if you sell your property before the term's over, boom, you cut it and you don't owe the bank anything. A closed mortgage though, that's the one where you can get into trouble if you decide to break your mortgage early because you've sold your property, either just to cash out or you want to buy something else. Now, closed mortgages sometimes will offer what's known as a portability clause, where the lender will allow you to take your current mortgage and then move it over to the new property you've decided to purchase. That's called porting your mortgage. Not every lender allows that, but if they do, they'll usually blend your present mortgage's interest rate with whatever interest rate they've got going on, right now in real time. Anyways, that's an option. If your closed mortgage though doesn't offer a portability clause and you break it, the banks or the lenders are going to charge you a penalty for breaking that mortgage contract. That's just how it is. Right now it's either 90 days worth of interest on the balance you owe, or they're just simply going to do what's known as an interest rate differential calculation, which isn't simple, and I'll explain it quickly, but it's another way of them getting their money. So with an interest rate differential, a few years ago, interest rates were really high, as everybody knows, and right now they're a fair bit lower. So the interest rate differential is the difference in rate between your mortgage and what rates are now. They're going to go and say, okay, say it's 1.5%, and you've got 23 months left on your mortgage. Well, they're going to charge you 23 months worth of interest on that differential on the principal that you owe. Now, that is complicated sounding, but I've got the whole thing on my website. The breakdown's there in text. It's probably a lot easier to follow than what I just said. But in a nutshell, if you got a closed mortgage and you want to break it, it's either 90 days interest or that interest rate differential. If you got an open mortgage, you're good to go. That's it. Thanks so much for watching. Have a fantastic day.